So, good morning and welcome to the Treasury Summit, ladies and gentlemen. My name is David Breer. I'm the CEO at Challenger Consultancy 11FS, and it's my pleasure to be joined at this virtual stage by Stuart Sopp. So, Stuart is the founder and CEO at Current. Current are doing some pretty amazing things, which we'll be sort of digging into as this session goes by. But what we're going to be talking about today is really about what the new rules are for banking. Obviously, the pandemic has changed, pretty much every aspect of our lives, not just the beards that we wear, but literally everything that is actually happening. And banking is going to be no exception to that in terms of the changes that we see in the industry. So will bank branches be a thing of the past? Is digital banking fundamentally here to stay? We're going to talk about that and find out lots and lots more. So Stuart, thank you so much for joining me for this session. How are you doing?
I'm doing well, and thank you for having me, David, today. And my beard is separate.
Well, if you didn't bring it, it would be weird. So, it's become for both of us. I feel like it's just part of the brand, really. Let's be honest. So, but for anybody who doesn't know about you and the work that you guys are doing at Current, can you start with just as telling us a little bit about your background?
Yeah, a little bit about my background. I was a trader for a long time in big banks like Citi, Deutsche. I've removed Deutsche from my resume now, just letting you know. It wasn't as cool as it once was. It's almost swearing on a resume. And Morgan Stanley, I was a foreign exchange short-term interest rate trader for 16 years. I managed various departments, some bigger than others. And that's a pretty interesting job in some ways because you can travel around the world. Currencies and interest rates are kind of the same in every country. It's a commoditized product. So it enabled a lot of travel, a lot of personal development and growth, personal consumer of financial products in places that don't have legacy banking infrastructure. And then came to New York and settled here 2011. So that's been my journey. So I haven't made it back home yet. So I'm English, despite all that travel in Australia, Singapore, Hong Kong.
Well, it's exciting. We were talking about this just before I think a few of the people joined in, but essentially you've been traveling your whole life, right? Your sort of childhood has been spent sort of moving from place to place with, as you say, sort of military bases and whatnot. So, that's clearly stuck in your blood in terms of that travel.
Yeah, that's right. So I wouldn't wish that on anyone, moving house every year and a half of your life. But it's given me great perspective on different cultures and different perspectives, different views, and also just different income levels being experienced in all those in those countries. So very valuable and hard to replicate. You'd have to go and live it, unfortunately.
Definitely a very different type of education, isn't it? The multicultural nature of the globe is an education process in itself, isn't it? But tell us a little bit more about Current then, and actually what's the mission behind the product?
Yeah, the mission very simple: to improve financial outcomes. So for people in their unique lives, our members, that came about. The mission came about from me looking at retail banking, and we were doing branding exercises, knew we wanted to be in this space, seeing the European competitors come through, in 2015 and wondered what the hell was going on. And no one was doing anything really here in America. That we had Bank Simple that had sort of launched and sort of settled themselves. And so looking at how banks were set up was pretty interesting because banks, their core KPI is deposits, which makes sense. They have net interest margin or income, and they go and lend that out, and that's how they make money, and that's a good business for people who can give them deposits. Now, there was this ever-growing demographic in America living paycheck to paycheck, which means about 50K, 35 to 50K household income a year, and so that means you sort of get paid on a Friday, and then all that money is out. Paying your friends back, paying bills, groceries, turning the lights back on, paying your auto loan, whatever it is, and having literally nothing left over, if not in a little bit of deficit. So, looking at that, it was just a very interesting problem to solve. I'd come from Wall Street, which was about enriching myself and a big bank, and a part of this capitalist efficiency mechanism. And felt like some of the best practices and some of the things we had learned, it was very technical back in 99 to 2014, 15. There was a lot of learnings that could be ported over to the retail banking side to really bring value to people and bank them in a way that's aligned with their interests.
That's really interesting because, as you say, there's been a few attempts, haven't there, in the US market, Move and as you say, Simple. But really, I mean, timing is everything for these things, doesn't it? And it feels like actually the momentum that we're now seeing in the market. And if I'm honest with you, really, quite honestly, the demand from a consumer's perspective are sort of almost outraged by that behavior, as you say, to really bring about that change. So, but how does that really sort of manifest itself in the day to day then? So, I mean, what does current offer that traditional banks are, I mean, seemingly unwilling to actually give their consumers?
Yeah, so yeah, good question. So the core value prop for our demographic, the people that we try to serve, which is people literally the money goes out on the day they get paid, like almost 100%. It's important to instill that because many of our listeners won't be in this demographic, is liquidity, and not just credit. So we have built our own tech stack. It took us about 2 years. We're obviously continuous development around that. But before we launched even one product, we have our own ledger, network decisioning, ACH origination, natural file passing, all the stuff that typically fintechs don't get to until much later on. In fact, almost all of them from what we can see. And we felt there was massive value in doing that. Firstly, the cost of servicing account, because when you're talking about, accounts that don't have any deposits, you've got to have a spend put through that you can monetize through interchange. And so having a lower cost of acquisition, lower cost of maintenance is vitally important. So we started off at that sort of level. And then as we built functionality, we started off with teams because when you're starting a brand new sort of, what's called current core, a brand new infrastructure, we really didn't have many features. And so the core feature was liquidity, getting the parents their money to their teams on the weekends. And then as we grew and expanded our product offering, we now have a full checking account, 18 to 35. And the core value prop for that is liquidity. So we pay the payroll 3 to 4 days early, or 2 to 4 days early, I should say. So if you get paid from Walmart on Friday with your colleagues, you will now get paid on a Wednesday. That's important. Why? Because if you've got like a T-Mobile bill, a cell phone bill, or some other utilities or bill pay, if you're paying them late, you're getting fined and feed. And if you're in a traditional bank, you're getting overdraft fees and fixed fees and all these other fees that are sort of hidden intentionally to get an effective interest rate for the bank because your deposits are worthless to them. So, and so getting that liquidity, getting the money that is yours early on a Wednesday is vitally important. We also have an interest-free overdraft. It sounds crazy to maybe some Europeans to sort of say this out loud, but that's few and far between as a product offering. I grew up as a student in the UK and had an interest-free overdraft for all 4 years of my college. And so that was a pretty easy product to develop here. Knew the value of that straight away. And also we do tactical things like when you have a with authorization hold, like if you go to a gas station, they'll hold at $50, $75, even if you're putting $20 of gas in, we then credit that back immediately. So giving people access to their money as quickly as possible is our core value prop. And banks are unwilling to do that because their core KPI is deposits. They want to hold on to the money and lend it. And banks don't really do a great job of lending anyway, right? As we've already seen. So tend to hoard those things. So materially different demographic and also technology, which is enabling us to do this. And then just at a high level, a totally different unit economic and business model. Right?
Well, and that for me is, I mean, it gets to the heart of the differentiation from the proposition, doesn't it? Because I mean, ultimately, I mean, in business, we all know that cash flow is king, right? And actually, from a personal perspective, getting people to understand the difference between getting that money 2 days earlier or the impact, not just having the money 2 days later, but the impact that can have, as you say, on all of the fines and fees that can be stacked up against that. So that can make a huge difference to people's financial well-being. And if I'm honest with you, a massive difference in terms of their mental well-being as well to manage through that process. Obviously, what we're here today to talk about is really the changing world that we're seeing. And obviously, with everything that's been happening with COVID, everything with the pandemic, pretty much everything is changing in this period, right? So, I mean,
that's right.
Really the safety net that big incumbent banks have been with for a long time is like, okay, I mean, that sounds quite difficult. Could you just fill in this form and go into a branch? And actually, the reality now is obviously in the period of lockdown, branches have not been open in the same way. You know, popping into a branch and filling in a form sort of doesn't really exist in this same sense. So, but for a challenger bank like you guys, you know, built on today's technology, not, you know, tech that was older than either of us, obviously this period is quite an interesting opportunity, right? So, I mean, how have you guys kind of been affected by the pandemic?
Yeah, so as a company, being affected, obviously, personally, just like everyone else, being part of this, work from home culture, going fully remote, trying to keep the business alive, also in a customer success fashion. If you can imagine a fully digital, fully online, mobile first bank that has 24/7 chat support, keeping that up and running, making sure that service was, first class. Was a challenge as well, and so congrats to everyone at Current who made all this happen and continue to sort of dominate this space. What we've seen in the pandemic is a sort of business strategy accelerant, is the best way I would put it. We were already moving to digital in many sort of vectors and sectors. But in terms of banking, there was this holdout, and I think it's born about by wealth inequality. And I go there pretty quick because of this. We've seen branch openings and net branch openings by companies like Chase, who have just had record profits announced, and Wells Fargo and Bank of America shifting their branches from impoverished neighborhoods to more affluent neighborhoods. And so what you're seeing here is wealth inequality built up by a bunch of structural reasons: Fed printing money, well, everyone printing money, including the UK and Europe. And what that's doing is inflating assets. So if you've got any kind of assets, you're doing well, clearly. Pandering maybe to an aging economy and voter base, that's another that's a different conversation. And to a younger demographic that Current services, average age is 27, right? Living paycheck to paycheck, living in urban areas, working in essential worker type jobs like nurses, military, warehouse workers, door dashers, Instacarters, people who are moving stuff during the pandemic. You're seeing them. Firstly, when we saw the pandemic hit, they were working harder, and we were asking them to work and risk their lives for us. So we were very proud to be servicing them in their time of need, making sure that their bank was working 100%. What we saw in terms of interesting change in metrics was that they were spending more, they were earning more over time, so they were earning more. And also those companies like Amazon and Walmart were hiring more. And so our increase in TAM, our addressable market, and all our metrics were doing much better. And so it was accelerating our business and our strategy of servicing people in this country. By the way, this number's up to 130 million people now. So this used to be a very small demographic in the 80s, which has just grown with this wealth inequality play that we've seen. And so this sort of lower tier, this striation, this lower income tier now is living on debt, right? They're living on liquidity. And my personal belief, I guess this is a sidetrack, but my personal belief is that we can try and close the wealth inequality gap through capitalism, through company, through private venture, and to do it the right way, as opposed to sort of defaulting straight to socialism, which, by the way, in some ways, through our data, I should just, as an addendum, pure capitalist society in America, bless it, I love this place, but the minimum wage is just simply too low. It's not livable, and I've seen it. And companies like Current are sort of finding the most innovative, grinding sort of, to the cents ways to get like $20 in someone's hands, $50. If that makes the difference per week, come on. I mean, all-time record markets, liquidity, 2.2 trillion. I think people need to be paid a little bit more money. So that would just be my one sort of get off my soapbox speech.
I completely agree. For us, let's stick on that though, because I think it's. I mean, we're gonna go off on a tandem here, but I think it's really important, because actually, to your point, it's not just the being able to put more money in people's pockets, but actually, I mean, the whole reason why you guys exist in the first place is to give consumers a better deal, right? To make people more financially well off. I mean, this week, having seen the announcements of record profits from JP Morgan. I mean, if I was a normal person on the street right now, actually, who is really struggling through COVID, who income has reduced and outlook is looking worse, to see an organization come out with record profits over this period, actually, I mean, I'm like, surely you should be helping people, not making more and more profit from people, right? So, I think that dynamic there in terms of what we're seeing, and actually how we better balance the business models of banking to really show transparency, but show fairness in those models, I think is exactly the right thing to be pursuing,
I couldn't agree more. I mean, bless them, record 4.4 billion in Goldman, and God knows how much in Chase. They are quasi-governmental institutions. They were proven to be bailed out and too big to fail and all this other stuff. And that's great, right? The government and the Fed, the Treasury, they need a mechanism to get liquidity into the system. Liquidity, not solvency, I should add, which is, we seem to be crossing into that moat right now. And so to me, they have more. They should have more oversight into distribution of those profits. America was built on capitalism, meaning everyone had a share of the upside, right? When companies were listing in the 80s and 90s, like Microsoft and Amazon and Apple, these were several $100 million companies. They weren't like the billions, even with inflation. 10, 20, 30 billion IPOs are insane. And so what's really happening is we're seeing a private wave. We're seeing this private money searching for yield when it's being printed, coming through pension funds, searching for yield in the private markets, delaying public listings. And so the average person, the mom and pop, who typically would have got on into a growth story, is now a bag handler, right? They're getting the last part of it. Of course, the last few weeks, this is all different with the liquidity injection. So we have like structural problems in the system of which greatness and fairness was built up. And so we need, unfortunately, the politicians, they're not even getting to some of these harder problems, right? They're just basic stuff, like we should be nice to each other. so we seem to be regressing. So we're sort of missing out. And of course, we will continue with tribalism and all this other stuff if we don't start addressing the wealth inequality gap that we continue to drive. So we have a unique spot where we're part an extension of the financial system. So circle back on like why branches and why digital. I think we're seeing this two-speed economy, wealth inequality, sort of rich and poor, and that's basically what's happening. And these forces are huge and very hard to stop. I think branches, just to sort of cap that previous comment, branches will be seen as high-touch, affluent people, and those experiences will be very akin to, like the Apple Store kind of stuff. People who buy Apple products typically have a lot of money. Or you could do a food analogy. Restaurants, high-end restaurants, great. You get the waiter, gives you, explains the wine and tells you about where your steak's from. That's great. It costs a lot of money to have that, and that person to be there hand on foot. But if you, for the rest of us, it's McDonald's pressing a couple of buttons and then on a machine, and then something comes out. And that's really where banking is going, is digitization to lower the cost of serving, and to make sure that, with these interest rates where they are and all the rest of it, that we're picking up these pennies to service the majority of people.
Well, it's interesting, isn't it? And I mean, obviously that shift then towards digital. And if anything, I mean, COVID obviously is kind of accelerating that narrative, isn't it? It's moving more people towards your model, and actually out of necessity, but by choice as well. So, I mean, have you seen a kind of an increase in demand for your product over the last couple of months?
Yeah, it's been actually kind of insane. I think you'll see this a lot in other conferences and just in general when you ever hear anyone talk about banking in general. It's all about trust, which is a little cliche, but it's true. There is a truth to it. And how do you build trust? Well, you deliver on a promise, and we delivered on our promise, and we were some of the best delivery in the market. We got stimulus checks early. We got overdraft facilities up and running. We got employment benefits plus like data around how to apply, all that other stuff. We became a source of truth, like a point of reference and a source of trust. And so what happens from that point in March, April, when we're running around like trying to adapt to this new changing environment? By the way, fintech startups really well suited to do that. We can move very, very quickly in a couple of weeks as opposed to years with a big incumbent. And so what that did was it increased our organic growth significantly. And of course, and then there was CPM drop off with other competitors pulling out, not doing so well, and all the rest of it. So we've seen an unprecedented growth spurt over the summer and early part of this year. I think we've got 1.2 million open accounts now, which is fantastic. I mean, who knew? this was going to happen. So, but we seem to, more luck than judgment, but we were doing the right thing anyway. So we seem to be in the right place in the right time.
Well, I mean, and in a geography where you've got scale, creating a
Yeah,
service and a product that people really benefit from. I mean, the virality that actually sort of comes with that in terms of people, particularly in the demographic that you're targeting as well, people talking to other people about something that's really helping them is a huge sort of point of advocacy. And I think your point around trust is really interesting because I mean I always say I think people trust incumbent banks not to disappear with all their money, but they don't
correct.
trust them to give them the right advice or give them the options that fundamentally make their wealth better off in terms of, or make them as an individual better off. So actually, if you can err on that side of trust, well, that's a product that can scale really exponentially. So congratulations with that success, albeit in an odd way, you know, obviously with everything that's happening with COVID. But I mean, really, what does that say though about the state of the banking market, do you think? Which is, I mean, you guys coming into the market, you know, you've come in with a fresh proposition, a positioning that actually gives you an opportunity to really serve a market. But to acquire more than 1 million customers in such a short period of time, I mean, really says quite a lot about how how much opportunity is being left on the table, right?
Yeah, I think banks and I was part of the banking industry. Don't forget, 17 years in those big banks, right? Very different role, but still part of that story. They don't mean any malice or ill will. It's not. It's their unit economics, their infrastructure and business model is not suited to the changing landscape. And so, just like we're seeing with incumbent cars like Ford and BMW, who are trying to make way, like banks tried to do the right thing, but Tesla started from scratch, and Tesla has full distribution, has energy, it has it has secured rare earth elements and all the way to distribution of that energy as well as batteries. So, and that's really what you're looking at is a tech stack that compresses and takes down and then collapses the efficiency into one, which enables like an order or several orders of magnitude efficiency to really bank people who have never really been banked before. Because as a bank, you can only focus on your unit economics like everyone else, risk reward and all that stuff. So I think it's very hard for banks to shift into this space, and that's fine. I think we'll see this, higher. When you talk about what you just talked about in terms of no one trusts a bank to give them advice, that's 100% true. I was only talking about this yesterday, and it's sort of the antithesis of what we do. There is a business out there that is almost like a reinvention of the hedge fund that gives really good advice, shows you what's a fair return, and then beats the return. Right, and you trust that it's a promise, and then it delivers on a promise quarter on quarter, and then you put more money to it. In terms of our demographic, it's all about liquidity and getting access. And if you draw a straight line from liquidity, it's credit, right? And so it's us getting them fair price on credit and delivering on that and making sure that it's not like predatory and all this other stuff, and making sure they get their money in their hands. And so that's that 2-speed above and below water, right? So you have more and more debt as interests lower. And if you've got assets, you're trying to find a return because interest is lower, right? So you have like two very stark business models. We don't intend to go across that line. We believe that we're going to do the most social good, and also just the biggest opportunity is where we sit. As soon as you go into more affluent customers, you're going up against the big guys who clearly are making record profits and have massive balance sheets. I've noticed we've got a few questions.
Interesting though. I'd say it's interesting though, isn't it? Because actually, as those models become more or less transparent, you can see more and more people sort of turning their back on banking, can't you? Particularly in the traditional banking space, which offers such a great opportunity from your perspective. But as you say, there's some interesting questions to maybe check in on the audience. But there was one here from Jen Zhu who says, "How are you guys overcoming barriers of digital banking across country lines?" They're particularly struggling with legal and regulatory compliance setups. But I think obviously from your perspective, different counties, different operating, different states operating in very different ways. I mean, how are you managing that as an organization? Because there's a lot of complexity when it comes to that, isn't there?
There is. In America, when we first started, looked at MTLs, we looked at a bunch of other sort of almost hacky ways to get up and running, as you would do. We partnered with our partner bank at the time issuing bank, MCB, and so they have a New York charter that's federally accepted, FDIC insured, and all the rest of it. With our existing a new banking relationship, Choice Financial in North Dakota, and so we sort of circumvented as an agent of those banks. Not circumvent is the wrong word, but sort of leveraged their regulatory and their licensing. Being a foreign exchange expert in some way, I did look at the sort of Revolut model before Revolut came here 5 years ago, and felt, maybe there's something to be done between Canada and Mexico. It's just not a problem that would really result in any sort of solving of a bigger problem. And of course, we've seen the NAFTA craziness, which would have probably disrupted that. And also this pandemic, I can't imagine foreign exchange backed or leveraged product doing that well in the short term, right? So that wouldn't have been good. In Europe, there's very many different problems. Of course, Brexit now maybe paves the way for other countries to rescind their membership, maybe. But the EU and Europe is, the banking is not meshed together, but there's certainly a single currency for a lot of them. And so the legal and regulatory compliance in Europe is actually pretty simple compared to America. You need a federal level sort of way in, and that solves that problem.
Yeah, definitely. I mean, the regulatory system always offers protection or opportunity, doesn't it? And actually, as that matures, it's going to give different parts of that to different people, isn't it? But and there's another good question here, actually, from Christina McDonald. So, what are your thoughts on challenger banks' partnerships and perk programs? Obviously, this is something that really sort of affects in the US. But do you think we'll see an increase of affiliates or partnerships post COVID? And what level of value do you think these programs really hold for B2C, but also the B2B side as well?
Yeah, I think this is a really topical question. With interest rates going to zero everywhere, when you talk about an impoverished community living paycheck to paycheck, the only savings, because they really don't accumulate any wealth, the only savings they ever make is top line savings at retailers. So if Walmart says, hey, there's 20% off, or the gas station gives them 20 cents off a gallon, or whatever it is, that's the biggest saving, right? It's worth way more than having $100 in the bank and getting 0.1% and have tax and all the rest of it. We have our own point system that is coming out fairly soon, which is very exciting. We're being beta testing. And we believe that getting as much value back to the consumer through these affiliates and partnerships is actually a large part of our future. So we're very much focused on that. I'm unsure about our competitors. I know that Chime started in this and then sort of got rid of it as they got bigger. I'm certainly hearing, obviously Varo going for a banking license. So we haven't really seen anyone else focus on this, but maybe this is a sign that we actually do focus on this demographic.
Well, as you say, as you build that trust with the community and you're offering services, these are things that will evolve as time goes by, right? And serving that community and showing the value you can add to them it will evolve over time in terms of how you do it. So, as you're so focused, as you say, on addressing that income inequality and actually everything that sort of comes off the back of that in terms of options and opportunities. What more do you think you can be really done to address that? Because this isn't an easy thing to fix, is it?
It's not an easy thing to fix. I think there's a couple of vectors in there, one of which is obviously minimum wage. We can't fix that, but we would very much like, as we go into a presidential election, for that to be a topic. And I think it's only fair. We've got the data to prove it. I think to sort of circle back to the previous conversation we had about asset ownership, we need to get equity. If what we're going to do is crony capitalism, bailout after bailout, and just keep printing and inflating assets and notional values, well, then let's get equity in people's hands. Let's go and not just pay people a minimum wage. Let's go and get equity in people's hands. And I think, when we looked at current at fundraising at every round, we're post Series B, maybe a C in the next year. We've looked at crowdfunding, which is very popular in the UK. Monzo and have done a great job in community building. And we looked at it here, and of course it's legal and compliant. You can kind of do it, but they have sort of a threshold for accredited investors over 250. There are a lot more rules and regulations that the SEC have put in for protection of our members. And I just don't think it's warranted. I think just because you have money doesn't mean that you're a smart investor. I don't think there's any correlation there. And I think that needs to be addressed. And we would love to get equity in our members' hands. And I would love big companies like Starbucks and Amazon, who all-time highs, right? And Facebook or whoever, Walmart. You're employing people for a sub-living wage in some cases, and they're part of your growth equity story. Why don't they get some?
Yeah, I agree. And at that point, like you say, then wealth on the upside is super, super important, isn't it? It's the bit where really all of that value is kind of created. I mean, to sort of close this out then, I mean, COVID's obviously not going to be going anywhere, right? We're in a situation where the world is going to be looking quite different, whatever state it's in, when we're all allowed to, leave our properties in a real way. But do you think digital banking and the changes that we've seen in this period will stick? Do you think there is this new sort of rule book that's being applied? Because it's always been people's adoption of digital, which has been the slowest part of the machine, essentially. But now that people have really seen all of the potential, do you think that digital banking is just going to go on from strength to strength to strength from here?
I do. And it was already happening. There will be a retracement for sure, just as we're like talking over Zoom or hop in and all these digital calls. There'll be a resumption and of somewhat normal life over the next year to 2 years, and we'll see the same for banking and finance. There'll be old habits die hard, but for this younger generation, it's entrenched. It's like I said, current banks an average age of 27 years old. If they were even wondering, they're not wondering anymore. And then we saw over the period of the height of the crisis in New York, we were seeing much older people, typically that would sign up for current, 50 years old, 60 years old, who couldn't get to a branch. And that's behavior change. And so, yeah, we have evidence and data to support that. This has accelerated in a more permanent way. Now, of course, we'll see banks and the big incumbents who can afford it to race to digital, race to it, mobile first, not just a website and all that stuff. I'm sure FIS and Jack Henry, all these guys are like trying to work out their strategy and who to buy and what to do and all the rest of it. But in some way, the race was already going on, and some of us are already a couple of laps ahead before everyone even realized there was a race, right? So.
Well, I mean, I think it's very similar to your point around investors. Just because you've got a lot of money doesn't mean you can spend it wisely. And if anything, incumbent organizations over the last 10 years have shown money doesn't equate really good digital services, does it? But I mean, you sort of slightly foreshadowed a little bit there, potentially like a Series C for Current. Is that on the horizon?
Yep. We're a venture-backed company. Obviously very hard to meet new investors in this environment, but we took a little bit of money recently from Foundation Capital, so very excited for them to join the board and the cap table. Great people over there. And we're crossing into the growth equity level, which is the catch up to some of the bigger sort of brothers in our space here in America. And so we're very excited about preparing for that level of growth. 1.2 million accounts open, but let's get to 10 as quickly as possible.
Now, that's awesome. Congratulations with the success then, Stuart. It's amazing to see such a great response to the product in the market and everything that's going on. Where can people learn a little bit more about what you're doing with Current, and I mean, you personally as well?
Yep. So current.com, we do have the URL unusually. So please go to the website and you'll see our blogs. And if you are interested in me, I'm on LinkedIn. Just come and friend me, and you'll see all the stuff. And Current, obviously, on LinkedIn, you'll see all the places that we're chatting about wealth inequality, serving a sector that banks have ostracized.
Fantastic. Well, thank you so much. There's loads of other questions that we haven't been able to get to.
Bad.
I mean, there was a couple of comments about beards that we really could have spent a lot of time on as well, but thank you for that, Andrew Morris. But I'm afraid that's all the time that we have. So if you do want to keep up with Current, loads of great opportunities to go and do that. If you want to find me, just David Breer over on LinkedIn. I'm always up to reasonably no good at that stage. That's all the time we have, though. So thank you very much, everybody. Goodbye.
Thank you.